So the tax filing deadline is quickly approaching. And with that in mind, what tax tips, what tax strategies can you take advantage of potentially to save in taxes, whether it's in this calendar year or over your lifetime? And that's what we're going to be talking about today. I am the Director of Financial Planning at Hapanowicz, and I am joined today with our founder and president, Bob Hapanowicz. Thanks for sitting down with me.
Absolutely happy to.
So, all right, we've got a list of tax tips that you put together,
Yeah.
Bob. And what we're going to do is just talk through each of them. So I'll name the tax tip and you talk away, okay?
Okay.
All right, so the first tax tip is file for an extension if needed.
Right.
Go ahead.
So if you're scrambling, it's tax time comes up here and then April 15th is right around the corner. If you're scrambling, you can file an extension. It's free of charge to do so. It's a one-page document. You sign it, your tax preparer, or you can file it. Your tax preparer certainly can file it. It gives you several months extra time to gather all your resources, et cetera, and make sure you're not making any mistakes.
Are there any financial penalties to do so?
None whatsoever. You do have to pay what you think is going to be the tax
Mhm.
by the time you file the extension. If you don't pay enough tax, there could be interest and penalties.
Okay. And that's what the CPA or accountant can with.
Yes,
So.
definitely.
All right. Yeah, many of our clients, I'd say it's a healthy mix
Right.
between which dates of the year that they're
Yeah.
filing.
I
So,
file an extension every year.
Yeah.
It's just easier. I don't feel rushed.
Yeah.
And inevitably something is late or changed, the 1099 or a K1, et cetera.
Mhm, mhm.
And this gives me plenty of time to make sure my taxes are accurate.
Absolutely. All right. Tax tip number 2, double check for deductions and credits.
You know, it's our right. I just want to say this. It's our right and privilege as an American citizen to avoid every tax that we can avoid
Mhm.
legally and ethically. So I want to insist that we take the time to review all of our tax deductions, our tax credits that we're available for,
Mhm.
file an extension, make sure your records are as good as they possibly can be, because it can be dollars and cents in your pocket.
Yep. Yeah. And you put together a list of common deductions. Is that correct? Would you like to go into those?
Sure, sure. So some common ones are medical and dental expenses. I made some notes here. Medical and dental expenses. Now, keep in mind that those expenses have to exceed 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000 last year,
Mhm.
7.5% of that is $7,500. So your unreimbursed medical and dental expenses above $7,500 can be deducted.
Mhm.
Itemizing your expenses can be a very good thing to do. Most of us just take the standard deduction, and the standard deduction sort of incorporates all those things so you don't have to add up all your receipts, et cetera, et cetera.
Mhm. And again, that would be something that your CPA or accountant would help you determine if should I be taking advantage of the standard or
Right.
itemized deductions.
Having good records is very important. Save all your receipts,
Mhm.
save your canceled checks, because those things should add up. If they're over that 7.5%, then
Mhm.
you can itemize and take advantage of that deduction.
Sure. Okay. What's next?
Okay, so state and local income taxes, SALT, we've all heard of SALT, state and local income taxes. With the 2017 tax law changes, that was capped at $10,000 per year. There's talk of that being lifted, that amount being lifted, but that's for future years. So you should save all your receipts, your tax receipts, et cetera, and state and local income taxes, those all can be deducted.
Okay. All right. And the third common deduction.
Yeah, so mortgage interest. Most of us have mortgage interest, or we've had mortgage interest, and that can be deducted. There's a lot that can be deducted. It's one of the bigger tax deductions.
Mhm.
So home ownership is every American wants to have a home generally, and the government helps finance that.
Sure. Okay. And number 4 I see here is charitable contributions.
Yeah, so even things like putting money in the collection basket at church, keep a record of that. The churches now, if you use their envelopes, of course, they provide you with a 1099 at the end of the year. But if you're just putting in cash, keep a record of that.
Mhm.
You can deduct that on your tax return.
Okay. All right. And number 5, casualty and theft losses.
Yeah, little known thing. So in Pennsylvania, we don't have too much of those, but in Florida residents,
Mhm.
with the hurricanes recently,
Mhm.
there are some benefits. So keep in mind that catastrophic events like that will be announced by the IRS, and there are some deductions for those unfortunate losses.
Okay. All right, so those are the five common deductions that,
Mhm.
you know, anyone could potentially take advantage of. And
Right,
this is a high level approach to speaking to these things.
right,
We recommend if any of these pique your interest or you think that this could apply to you, talk with your CPA or accountant, as soon as possible leading up to that filing deadline,
Right.
to get well ahead of it.
right. So there are some things that are tax credits. I know
Mhm.
you're going there
Yeah.
next. And I just made a couple of notes. The Earned Income Tax Credit, the EITC. There's a child tax credit that is available. There's the American Opportunity Credit and the Lifetime Learning Credit. So some of these are focused on folks that are young Americans that are going to school or going to college.
Mhm.
The LLC, Lifetime Learning Credit, is for those of us who want to take the occasional class, maybe at a university or Point Park College or whatever.
Sure.
And there is some credit for taking that class
Mhm.
and continuing to go to school. So the other ones have quite a bit more record keeping requirements,
Mhm.
but there are credits available. And to keep in mind that a credit is actually a refund to you.
Mhm.
If your credits add up to more than the taxes that you actually paid, the government will send you a check back
Mm.
for the difference.
Mm.
It is a cash refund.
Yeah.
So it's important to take advantage of those.
Mhm.
Those phase out for certain folks that have income above thresholds. So if you're making a very high income, you wouldn't qualify for those.
Mhm.
But if your income is more modest,
Mhm.
then you can qualify for those
Okay.
tax
And that's a
breaks.
dollar for dollar.
Dollar for dollar.
Yeah.
Yeah.
Okay.
Mhm.
All right. Tax tip number 3, max out retirement contributions.
Yep. We've all heard of this, right? So IRA contributions for most of us are either partially or fully deductible.
Mhm.
Again, if you have income above certain thresholds and they are not deductible, or if you're covered by your employer's, you or your spouse are covered by your employer's 401k or other retirement plan, then they may not be deductible. But it should be something that is explored and your tax preparer, or even if you're using TurboTax can
Mhm.
help you with that calculation.
And even if a contribution isn't deductible in that year, there still could be
Yeah.
benefits
Right.
to making that contribution because the
Right.
growth
Right,
on that contribution is tax deferred.
right,
So I mean that might take some record keeping,
Yes.
proper record keeping,
Right.
but it's something to run by your accountant or CPA.
Right.
Just because you might not qualify for a deductible contribution doesn't mean that it should be completely off the table.
right, exactly. And things like Roth IRAs are a tremendous tax planning tool. You don't get a tax deduction for doing that,
Mhm.
but if you have extra cash
Mhm.
and you want to save long term, the Roth is a wonderful
Yeah.
place to put it.
And you put just looking at your notes here, I mean, especially if you are self-employed,
Mhm.
talk with your advisor and your CPA or accountant because they have the knowledge of the different types of retirement plans. And there could be an opportunity to take advantage of more tax deferred savings and contributions compared to what you might already be doing.
Right,
Every type of business, depending on its demographic, might have a different recommended qualified retirement plan to be put into place. So that's something that your CPA and accountant or your advisor can assist with.
right. And if you're a small business owner, up until the time you file your tax return, you can make these contributions to a retirement plan.
Right.
So,
Yeah. And I'll just say, just with my financial planner hat on, thinking about an individual listening to this, just because you can max out on those contributions doesn't always mean you should. Saving into that retirement plan is one component of your cash flow plan, is one component of your savings plan. And so we don't want people to blindly save into that and neglect other areas of their cash flow needs or their savings needs. But absolutely, if everything else is in place and is in good order and you're not taking full advantage of those contributions, I mean, it is, especially in high earning years, it is a huge benefit, especially when you think about it from a long-term perspective.
Mhm.
So,
yeah, good point.
all right, tax tip number 4, use the standard deduction if itemizing doesn't help. We kind of
Right.
talked about this a little bit, but
Right.
let's talk about it more.
Yeah, so if you're single, and you don't have itemized deductions totaling $14,600, you're better off just taking the standard deduction.
Mhm, mhm.
And if you're married, 29,200 is the threshold, so you'd have to have a lot of expenses to not just take the standard deduction.
Mhm.
But occasionally that happens, and you should save your receipts and review those at the end of the year.
Sure. Okay. Tax tip number 5, don't forget last minute HSA contributions.
So here at our firm, Hapanowicz Financial, we have an HSA, and participants, employees here can contribute into the HSA. It works a lot like an IRA account
Mhm.
because the money goes in, it is tax deferred growth. And you get the benefit of either drawing it out for qualified medical expenses, or you can save it for retirement if
Yeah.
you don't use it.
Yeah, it can, in layman's terms, work just like an IRA down the road if you don't use it for qualified medical expenses. I was guilty of this for a while. You can kind of forget that the HSA exists,
Yeah.
right? Especially if there are automatic contributions going into it. But that is absolutely another strategy or tactic to take advantage of if you have that extra cash flow
Mhm.
to put towards.
Yes.
So.
Yep.
All right, tax tip number 6, keep good records, check for errors before submitting.
Yeah, and we talked about that a little bit earlier.
Yes.
If you don't feel comfortable, if you feel like you're rushed, file an extension.
Mhm.
Again, it doesn't cost you anything to do it. And that way you have the luxury of time to go through all of your receipts, et cetera, talk with your tax preparer, and make sure that you're taking advantage of every dollar that you can get back on taxes.
And your accountant or CPA will have recommendations as to maybe the best way to keep track of things if you're needing ideas. Going back to the HSA, I just know this from personal experience. A lot of HSA plans give you that technology to help keep track of those expenses.
Right.
And so, your CPA or accountant will have some best practice recommendations for that.
Mhm.
Best to do it as you're going along,
Yes.
rather than trying to scramble and get
Yes.
everything together.
Definitely.
So, which I think can apply to many things in life. But okay, tax tip number 7, e-file for a faster refund. Yes.
Yeah, so most tax preparers today are e-filing.
Mhm.
It's a very simple thing that they apply to the state of Pennsylvania for an e-file number. And that way, when you're done, you sign your tax return electronically after you've approved it. And if you are lucky enough to get a refund, you're going to get it back right to the checking account that you originally wrote the checks on.
Right, right. Yep. My husband and I do that, and
Mhm.
it's very convenient. So,
Right.
all right, tax tip number 8, consult a tax professional.
Yeah, usually for a small amount of money, we recommend having your taxes done professionally by somebody who's qualified. Maybe not the cheapest person out there, but somebody who is qualified and they're keeping up to date with, first of all the software that's available, number one. Number two, they're doing all the continuing education.
Mhm.
Number three, they're attending all the seminars and webinars, et cetera, to make sure that they're going to help you keep good records, number one. Number two, get you every nickel that you can get back from,
Yeah.
paying your taxes.
And also too, just as an advisor, from an advisor's perspective, for every one of my clients, at least, there has been an occasional time where a client has a question that we really should be asking a CPA or attorney. I can give my initial thoughts or feedback, but if it turns out to be tax advice, then that's when we have to pull in the CPA or attorney. So if you already have that established relationship, it's really helpful to be able to just pick up the phone or send an email, or we do that on the client's behalf a lot of the time. Speak directly with the CPA or attorney. So you just never know when having that established relationship
Yes.
can be just really beneficial
Yes.
and convenient.
No doubt.
So.
No doubt. Just when you need it the most is when you're going to want to have that really good
Mhm.
professional. And if you're scrambling to find that person at the last minute, a lot of the CPAs that we work with today are not accepting new clients.
Yeah.
They're not accepting new clients. So establishing a relationship with somebody, I think, is very important.
That's a really good point. Even if they are accepting new clients, to try to get in touch with a brand new CPA or accountant at this time of year is going to be incredibly difficult because they are so busy. What I have done, and what the advisors here do a lot of the time, is we make that introduction maybe in the middle of the year, far enough away from any of the tax filing deadlines throughout the calendar year. And that way things are a little more calm for the CPA or attorney. They might even have some time to have an introductory phone call with that client rather than just diving in and saying, give me your, tax returns from last year. So it's able to be less transactional and a little more of surrounding the relationship when we take our time and kind of get ahead of that filing deadline.
And
to
we're
make the
pretty,
introduction.
yes, it is. And we're really good at matching the client to the tax preparer or the CPA. We know a lot of these folks, And therefore we can make the referral that's going to be really good. The synergies are going to be
Yeah,
there.
absolutely. I mean, for those who are watching or listening, client or not a client of Hapanowicz, if you're in the Pittsburgh or surrounding areas and you're needing a CPA or accountant referral, give us a call. We are happy to connect you with someone. It's always nice to connect with one of your advisors, whether it's financial advisor, tax, or estate planning through a referral, right? So we're more than happy to do that.
Yep.
All right. Tax tip number 9, plan for next year.
Yeah, so we're done talking about this year. And next year, we have helped clients minimize their lifetime taxes through good planning. And I'm going to go over several things that we look at and talk about with our clients. So at our firm, we spend seasons of wealth management is our service process, and we spend one of the seasons just talking about tax planning. It's so important. We're always going to talk about people's money, how it's doing, et cetera, and their goals, vision, objectives. Yes. But talking about taxes, it is one of the single largest areas that we can look at and help clients with their lifetime tax costs and reduce it significantly. So one of the first things that we do is for folks that are retired, there you enter oftentimes into what we call a income trough or a tax trough period. And that's the time between when you retire and you are required to start minimum distributions from your retirement accounts. That often can be a really good time to do things like a Roth conversion or recognize income from other sources during those years when you would be paying lower taxes.
Yeah.
So Roth IRA conversions are a big deal. There's been a lot of talk about those lately, and we can help you navigate that and do it in as low cost method as possible.
Roth conversions are not just a tax saving strategy for you and your spouse if you're married. It's a tax saving strategy potentially for your next generation as well.
If you're so inclined.
Yeah,
Right.
if you're so inclined. There's many considerations for Roth conversions,
Right.
and it's something that, I mean, our planning department and along with the advisors, we are looking at for every single client.
Yeah. So the benefits of a Roth IRA are your money grows tax-free, distributions come out tax-free, and you're not required to take these RMDs, required minimum distributions at age 73. So the money that's in a Roth is really, one of the true tax shelters left out there that is available to every American.
Yeah. Okay, what's next, Bob?
Okay, so adjusting your investment style. Oftentimes we see clients with high tax investments, things like CDs, as an example. So if you have a CD and it's federally taxable, state taxable, et cetera, oftentimes just using, for example, a US Treasury security, which is full faith and credit of the US government, as safe as a CD, maybe even safer. But it's only federally taxable. The state of Pennsylvania does not tax interest or income from treasuries. So right away, there's a tax savings.
Yeah.
Other things that you can do is consider capital gains in oriented investments like dividend paying stocks, et cetera, or even exchange traded funds that tend not to pay high capital gains distributions, and you can kick that tax can down the road. And the benefit of kicking the tax can down the road is you get to recognize the taxes when you want to receive them, not when somebody else tells you you have to get them. It's always better if you can do the planning versus somebody else telling you what to do with tax planning. So adjusting your investment style, dividends, for example, from stocks are qualified. So they're taxed at lower rates than is interest from CDs. And you can buy stocks with dividend payments that are roughly the same as certificates of deposit. And you're getting more favorable tax treatment.
Yeah.
So adjusting your investment style. Now, if safety is your number one priority, we understand that protection of your principal is the number one consideration. We understand that there are still some things you can do to secure your money and kick that tax can down the road, or even eliminate some taxes.
Okay. I think the tax consideration is not something taken into account often enough.
Right.
Especially when considering CDs. And there is and can be a place for CDs, of course. What we do here at Hapanowicz as advisors is twice a year we are looking at our clients' balance sheets and putting it in front of them. And the reason why is, we can give the best advice if we have our arms wrapped around their entire wealth, not just the aspects of their wealth that we have direct management over on a day-to-day basis. And so if you're ever wondering, hey, I have this extra cash, it's in a CD, or maybe it's not, maybe it's just in the savings account at the bank and you're not sure what to do. Ask your advisor, give your advisor a call, and they can assist you with where to best allocate that money, depending on what your needs are for that cash. So,
Right. Oftentimes we can help save you a bunch of money,
Yeah.
taxes.
all right, what's another way we can plan for next year, future years?
Yeah, so oftentimes there's the ability to defer income into future years. And that's part of tax planning.
Mhm.
And we would help you do that. You have to start now for this year. You can't wait to the end of the year to do this. We have to start now to start planning this for future years. So this is all, we call this tax planning. It's not tax preparation. We're talking about tax planning now.
Mhm.
And that is an ongoing multi-year exercise that we help clients with. And is it terribly difficult? No, but it's something that we have to be diligent about and spend a little bit of time doing with you.
Sure. All right, what's next? What do you want to talk about next, Bob?
With everything that we're doing, the number one consideration for folks that we ask you to do is make good economic decisions first and foremost. Oftentimes we hear people, oh, I don't want to realize a gain on a stock because I don't want to pay taxes. We think that's actually a little bit backwards. Nobody wants to pay taxes. I don't want to pay taxes needlessly. And it is our right to avoid taxes or kick the tax can down the road as much as we possibly can. And I want clients and myself to take full advantage of that ability to kick the tax can down the road.
Yeah.
But we need to make good economic decisions first and foremost. And sometimes it's just the right time to sell a stock and realize a gain. Isn't that great though? If you pay some tax because you made money,
Yeah.
that is a good thing. I just don't want to pay any more than I have to.
Absolutely. And it's one thing that's part of a bigger picture.
Mhm.
And so that's why, having that conversation with the advisor and the CPA or accountant is incredibly important to help coordinate those types of things. We've got one more thing on the list here. Go ahead.
Offsetting gains and losses. So as part of the tax planning, you should be through the course of the year talking with your tax professional. It's a three-way conversation: client, the investment advisor, financial planner, and then the tax professional, perhaps the CPA. And let's examine where you are with capital gains and capital losses, offset as much as we possibly can. Keep in mind, it's okay to realize a loss. If you have a bad investment, realize a loss. You may not have a gain right away to offset it against, but losses can be carried forward indefinitely. Okay, they can be carried forward indefinitely. Now, I just want to caution you. If you have older parents, they're in their 90s, for example, and they have capital losses and it's in a joint account, and one of those spouses die, half of that loss is lost permanently. So you either want to reposition assets or realize those losses against gains in a way that you don't lose that loss carry forward.
Yes.
That loss carry forward is money in your pocket.
Yep.
It is literally money in your pocket.
Yes,
That's
absolutely.
my last tip today.
Just talking through all of this with you,
Yeah.
if it's okay, I
Yeah.
have an impromptu 10
Sure.
tax tip.
Okay.
Okay, so tax tip number 10 is specifically for those listening or watching who are not clients of Hapanowicz, and that is to ask your advisor to have a conversation with your CPA or accountant at least once a year.
Yep.
I say that it's for non-clients of Hapanowicz because as a client of Hapanowicz, this is something that we are automatically doing on our client's behalf. I can't stress enough the importance of doing this. Admittedly, sometimes we walk into these meetings or pick up the phone, not thinking anything will come from it, but we still do it because it's the right thing. And then something comes from it. A planning strategy, an opportunity comes from it. And when every investment decision that your advisor makes on your behalf or with you has a tax implication, it may even have an estate planning implication just to bring everything together, right? It all works together. It's all cohesive. And so bringing it back to taxes though, when your advisor has that cohesive back and forth with your CPA or accountant, that's where you can identify those strategies and use them to the max, not just for you, but potentially for future generations as well.
Yes.
So it's incredibly important. And I can say that with confidence, just from experience and of having those conversations for so many years, what comes from those conversations. So
Awesome. This was fun.
all right. Yeah, it was fun. Thanks
Yeah.
for sitting down with
All
me.
right, that's
Those are the
great.
10 tax tips. If you have any questions, if you want to talk through any of these in further detail, give us a call at the office, reach out to your advisor. And we'll see you in the next video. Thanks, everybody.